I believe the court's decision to strike down my student debt relief program was a mistake, was wrong. I'm not going to stop fighting to deliver borrowers what they need. Today's decision has closed one path. Now we're going to pursue another. I'm never going to stop fighting for you. We'll use every tool at our disposal to get you the student debt relief you need and reach your dreams.
That was President Biden on Friday announcing new actions on student loans after the Supreme Court blocked the administration's loan forgiveness program that would have delivered up to $20,000 in relief for individual borrowers. Well, meanwhile, Congress ended the 3-year pandemic pause on student loan payments, so borrowers will start paying back their loans this fall. Now, here with what this means for the economy and the housing market, I want to bring in Chen, Moody's Analytics senior economist, and Thomas Simons, Jefferies U.S. economist. Great to see you both. Lou, let me start with you just in terms of the economic implications of this. How do you see this impacting the consumer and more broadly, the economy?
First of all, thank you for having me. This means starting September, October this year, average student loan borrower will have to start paying on average $275 every month out of their discretionary budget student loan payment. And this is adding additional pressure on the already unaffordable housing market for the US by and large. So we look at the differential between the Class A versus Class B and C rental market and identified across 79 majority of the US metropolitan areas, trading down from Class A to B and C units would create potential surplus even after paying that additional $275 every single month.
Thomas, that number that Lou just pointed to, $275 a month, roughly, potentially up to $300. I mean, it really does depend on what an individual's financial situation is. But when you all add it up, what's the impact to the broader economy?
Yes, you make a very good point. And this is something, I'm sorry.
Oh, Thomas, go ahead.
Go ahead.
Okay, yeah, sorry. So this has been one of our major themes for the economy and our outlook for this whole year so far. And we've done a lot of work in trying to figure out exactly what the impact is going to be. And as you point out, the loan borrower base is extremely sort of heterogeneous, right? There's not that many, common themes that you can paint across, broad swaths. So some people, their payments are substantial because they have not only, a big load from undergraduate debt, but also graduate debt. They may have multiple children that they're paying tuition for as well. And then there's other people who are on income-driven repayment plans whose, nominal payment is a very substantial number, but it's not what they're actually paying because they're only actually having to pay a percentage of their income. So taking it all together, our estimate ended up being slightly higher, but I wouldn't put, a tremendous amount of confidence in that. The way I look at it is it's pretty similar to what happened in 2013 with the fiscal cliff. And if you recall back then, essentially the net effect of that was a 1% increase in the payroll tax. And, 1% increase in taxes equates obviously to a 1% decline in disposable income. And the aggregate impact is very similar here going forward. The difference being that there's only 40 to 45 million student loan borrowers, and that payroll tax affected well over 100 million people. So you're talking about a smaller group that's hit significantly harder and a large group that, can essentially continue on without much of an impact.
And Lou, with that in mind, and you pointed to this very quickly, but digging down a little bit deeper into it, just in terms of what this will do to the inventory shortage, an issue that we're already facing when it comes to housing, what it's going to do to exacerbate some of the other structural challenges that are already taking place in the housing market. What exactly does that potentially look like over the next 6 to 12 months?
Absolutely. So when we look at the entire housing ecosystem, so the United States has been facing this housing shortage for the past decade or even longer. So at the beginning of the century, if we look at the inventory of Class B and C rental units, that's roughly account 2/3 of the total rental landscape. And coming down to the first quarter of second quarter 2023, that number, that ratio of more affordable Class B and C units is only account to less than half of the total rental inventory. And overall, if we look at the housing shortage, a lot of that shortage exists in that structural imbalance, meaning for the renter on the margin. So if they couldn't get into this very competitive Class B and C market, then they have no option but to enter into the more pricey, cost-burdening Class A rental units. And that is exacerbating this housing shortage and affordability crisis. So by the end of 2022, according to our tracking, on average, the US renter is paying 30% of their monthly income on renting an average priced rental unit. And that 30% is classified as the rent burdening threshold. And that's not accounting for utility. That's not accounting for other discretionary spending. So with that, keeping that in mind, having to spend additional $275 is actually creating less financial buffer, which they could be enjoying on the service spending, on the goods spending, on the retail, and other forms of spending in their life.
Yeah, so let's pick up on that point, Thomas. Lou's focused specifically on the real estate sector, but I know you're looking more broadly at the economy too. I mean, what are some other sectors that you think could get particularly hit? Retailers, for example, have been warning about the potential hit to discretionary spending.
Yes, I mean, it is pretty wide ranging, and I think that's because there are some significant knock-on effects that maybe we don't just consider when we look at just the sort of what the actual number is in terms of the payment. We're talking about reversing an impact on the economy that has been a continual stimulus for the last 3 years. Like each month that people haven't been having to pay their student loans, there's been extra money that's been floating around in the economy as a consequence. Another thing to keep in mind is that without having to make these payments, people maybe looked at their budgets in a different way, thought about their overall debt burden in a different way, and took on debt in other areas that maybe they probably wouldn't have had they had to continue paying their student loans, right? So a good example of this is in autos, where we hear essentially every day about more and more kind of troubling statistics about the bubble that's formed in the auto lending market. Very high monthly payments, loan to value ratios over 100% for depreciating assets. And of course, it obviously doesn't help with people's ability to pay for their housing, whether that's in the for sale or rental market either. So I think that, combined with anything that is really leveraged to debt, I think is at threat. But the other issue is I think that, just in terms of discretionary spending, people feel like they had a promise broken to them, right? So this can have a pretty significant psychological impact just in terms of, how people view, essentially what they can take for, at face value from the government in terms of, what policies are being discussed. And also just generally kind of the sense that you can never get ahead in an environment where inflation has been running at multi-generational highs as well.
So, Thomas, then with that taken into consideration, I guess, how does this then factor into the probability of a recession and what we could see the economy look like here, at least in the short term? Because there has been so much debate leading up to this, ahead of this decision, obviously, about whether or not we were going to see a recession. Lots of calls that we would have seen one by now. But largely speaking, we are in an okay place. Is that all about to change because of this?
Our view is, yes, essentially we're kind of at a plateau in the economy, right? Where growth rate, slowed down pretty significantly in Q1, the revisions from last week notwithstanding. But Q2 is shaping up to be pretty poor, in my opinion. And with Q3 and Q4, more Q4 than Q3, I suppose. But, with the end of the year clearly going to be burdened by these student loan payments, I am concerned that we're probably going to go into a recession before the end of this year, maybe the end of Q3, beginning of Q4. Now, that doesn't vary terribly from where we were before we started to factor in the student loan repayments. We had always been kind of focusing on household cash balances and where sort of we sit with excess savings that was accumulated during the pandemic. It was as high as $2.2 trillion in the middle of 2021. Since the end of 2022, consumers have been spending down that savings. Savings rate bottomed in June of last year, and it's actually been rising since then. So you no longer have this tailwind from people spending down their savings. It looks like they're actually trying to repair their balance sheets instead. And that's good for them, but it's bad for the economy in the short term.
Finally, Lou, you were talking about the potential shock that could be coming for the real estate sector. We have seen in the past some of these shocks, particularly around graduates, have a lasting impact. And I'm wondering, when you're thinking about those students who haven't had to pay down for several years now, I mean, if you're looking specifically at the real estate sector, How long until we start to see things stabilize again?
So it takes quite some time for the real estate market to stabilize, and it might take even longer for us to start seeing the marginal impact. So during the past recessionary period or economic downturn, what we've seen when the trading down option has been exercised or more evident influence has been shedding on other commercial real estate sectors such as retail, it usually takes months up to years until some of the effects started to manifest it, especially considering the lease term, and usually it's longer than a year also. So we started seeing some of the effects started to trickle down towards the mid or end of the recessionary period. And it takes longer because some of the construction will take longer to complete, and some of the leasing rollover will take up to a year or even longer to start reversing. So we might even see longer time for that potential damage to be repaired after the recessionary or economic downturn.
Chen with Moody's Analytics and Thomas Simons from Jefferies. Appreciate both of you providing the context. Thanks so much.